for the Fed to pause, we've said for a long time, you need disinflation and inflation to come down to levels they're comfortable with. I think tomorrow we're going to get the third consecutive core CPI print at 0.2. That's enough for them to pause with a lot of the other disinflation that we're seeing. I think this time for them to cut rates, they're going to have to see unemployment go up. So it's possible that they may actually tip the economy into recession first before they start cutting rates, which would be something new for them. It would be positively ECB-like.
Well, okay, but going forward then, how does this cohere with a 3% yield curve across the board, a flat yield curve in the near future, by the end of this year, or even by mid-year next year? If you have a Fed that's being patient, not willing to cut, and you have economic data that's coming in hotter than expected.
Well, this is the Fed that promised us transitory and then within a couple months changed their mind and started hiking rates. We think we're going to see the same thing this time. They're going to tell us that they're going to keep rates higher for longer until inflation is at their target. But the magnitude of the slowdown we're seeing across the board tells us that we'll probably still be hitting recession around year-end, so they'll be cutting rates by then. So I'm still incredibly comfortable that we'll see 3% across the curve.
Do you think high for longer is just a bad call, or do you think they're just misleading us, that that's what they want to signal currently?
I think it's what they have to signal, because they were already wrong once on inflation with the promise of transitory. They can't be wrong again. They're telling us that they're prioritizing inflation over growth, and that means, like the ECB, you're willing to make the economy a casualty.